wholesalers ruining the market, tariffs destroying opportunities for builders. The market's absolutely crashing. It's 2007, 2008, all over again. Nate, is that correct?
It's a lot to digest, Darin.
Absolutely.
I would maybe rephrase that and say that wholesalers have substantially changed the investing market. Certainly in the last 5 to 10 years for sure. I don't know if they're destroying it, but they are certainly changing it and making it more difficult for the individual investor to find homes and make this a full-time part of their income for sure.
Right. What about tariffs? What about the feeling that this is an 07, 08 type of crash?
The crystal ball is a dangerous place to go to.
That's why we're talking right here.
Exactly. So I would say that the environment that we're in right now, in my opinion, living through 2007, 2008 is completely different. I don't think that it's the same situation. You hear a lot of fear out there, right? You hear a lot of, but let's just be honest, fear sells, right? It gets a lot of views and gets a lot of attention. Right. I think we're way too early in the stage right now to see and to know what real effect this is going to have on the real estate market for sure. And
so tariffs, I think they've come out here recently, and I am by no stretch of the imagination an expert on tariffs, but they've, from the building standpoint, for builders, not nearly as significant as they were anticipated to be.
Not yet, for sure. Let's be honest, like over the last 5 years, we've already seen an increase, substantial increase in the cost of materials, right?
Right.
And so, builders, investors are already scrambling to try to figure out their profit margin, to try to figure out what they can or cannot do, the quality of what they're putting into their homes. So this isn't anything new. We've been seeing that for quite a while. And quite honestly, we've, for us anyway, on all of our budgets, we actually require a 10% contingency because of this trending upward.
Sure. And my name is Darin Hunter. Welcome to our podcast today. Welcome to my show today, where I'm interviewing Nate Wolosiewicz.
Very good.
All right.
Very good. Perfect.
First
Nailed
time.
It.
With, Consistent Capital. I want to say clear cap. Consistent Capital.
Yes.
So Nate has been in the mortgage industry for many, many years. He and I connected here over the last couple months. We've had some great conversations. And I said, I've got to have you on here. We got to discuss some important topics. Nate, tell everybody why you're on the show, what your expertise is, who Consistent Capital is, and why your opinion matters in this discussion today.
Yeah, first off, thanks for having me, Darin. I appreciate that. I've experienced quite a bit over the last 2 decades, going through the 2008, 2009 debacle, and then going through the COVID years. And, of course, we experienced the fruits of all of our labor over the last, 10 to 15 years with the rates the way they are. But we're in this interesting period once again. So I would say that I've gone through a lot. I've been battle tested, bloodied, bruised a little bit, as we have, But, with experience, with all that experience comes a lot of different situations that, I can advise on. And I've seen that. I've seen a lot of things in this industry, good and bad. So I'm here to help advise, help guide our investors. So Consistent Capital, what we are is we are a private money and hard money investor lending institution. So we are business purpose lenders. What that means is that we are going to lend to only non-owner occupied homes. So, that investor that's buying a fix and flip, maybe a rental, building new construction, those are the only types of properties that we are interested in. Someone comes to, with a primary residence, we're not interested. In fact, if we find out that investor is going to be living in the property, it's a hard stop for us.
What's one of the ways that I see this on a regular basis? People trying to get savvy, trying to play the system, work within the rules, if you will. How does Consistent Capital verify that that individual did not move into the property after it's been built or after it's been purchased or flipped, quote unquote?
Yeah, that's a great question. So, not going to lie, it's happened. It doesn't happen very often,
Sure.
right? But we actually do have the ability to do a post-closing audit on the property to ensure that a tenant is truly living in the property, right? Now, it doesn't happen very often, and the reason why is that we mitigate our risk on the front end, right? So we want to make sure that our investors own their primary residence and there's a history, that their identification, their ID, their bank statements, maybe we ask for a utility bill. They're proving to us that they own a primary residence and that they're not going to be moving into it.
Sure.
So we do mitigate a lot of that up front. Can't say that hasn't happened, but we do reserve the right to do an audit and send someone into the home to ensure that these investors are not living in the properties.
So you could literally knock on the door and ask, hey, who are you, so-and-so, Mr. John Smith, who purchased this house X as a flip? They say, no, I'm renting this property. That becomes a callable note at that time.
Yes, absolutely.
Yeah.
Absolutely. And why would someone do that? Well, there's a lot of different reasons why, but the biggest reason is that we see is a lot of people, maybe they're self-employed, maybe they don't have verifiable income, or maybe their income isn't enough to qualify for a primary note. We don't require those financials. We're asset-based lenders, so we're more worried about the asset than we are the investor.
Right.
And so we're not going to ask for W-2s or tax returns or pay stubs or anything like that. So technically, it's easier to qualify with us on long-term and short-term stuff. So, admittedly, there's some people that try to take advantage of it, but I would say the majority of the people are true investors looking for business purposes only, and do this for either a living or a side hustle.
Right. Now, you mentioned institutional, private. Can you tell everybody what the difference of that is, or why there's the combination of the two, and some of the subcategories of what that is? I know there's a lot, but just kind of give us an overview of what that all means. Yeah,
especially when you get into the Atlanta market. There are so many different sources of capital, in this market. It's tough to go over everything, but at a high level, if we were to go back 10 to 15 years, or even back to 2008, right? A lot of the hard money, if you will, was truly private capital, individual capital. Maybe it's, raised capital from corporations, and they're making their own decisions. They're not really worried about the credit score. They're worried about experience, right?
Sure.
Has this investor successfully exited and performed? But they're going outside of typical guidelines. They're maybe making up their own guidelines, if you will. We live in the gray in hard money and private money. Fast forward, right, from 20 years ago to about 10 years ago, this thing called institutional private money started to come into play.
For example, who's an institutional investor out there that somebody who's watching may recognize the name?
Yeah, so some of the bigger ones would be like Turac, BlackRock. The big players, right? The big players. These are aggregators, right? And these are the guys that have the money. And so lenders like us, what they did is they saw there was a lot of profit in hard money, not just the short-term stuff, but also the long-term stuff. So these loans called debt service, loans started to pop up.
What's a debt service? Break that down for me.
Yeah, so debt service, if I could just break it down in its simplest term, these are 30-year notes, long-term notes. And all we're simply doing is looking at, does the rent from a long-term lease, or maybe it's a Airbnb, the income from the Airbnb, or the market rent, whichever is lower, does that cover the monthly payment? The PITIA payment.
Right.
If it does, and the investor, the PG, personal guarantor, qualifies, we're okay, closing the loan at whatever leverage it is. Could be 75, could be 80, whatever it is. It's pretty simple loan, but the institutional money started to come in, and now we've got more guidelines. Right. The private institutional money.
And that's just to mitigate or manage the risk that they're putting out into the market.
Correct. So the benefit to private institutional money, whether it's long-term or short-term, is that they're better terms, lower rates, right? Longer terms, no prepayment penalties, much more forgiving. And what the investor is about is margin, right? Profit. Ideally, you want to put more money in your pocket. How do you do that? You get better terms, right?
Sure.
So usually the private institutional money comes with that. The true hard money, right, which is abundant in cities like Atlanta, the benefit to that is that it's a lot easier to qualify.
Sure.
Right? So it's not credit centric. So if someone maybe has bruised credit or is going through a rough time right now and they just wouldn't qualify for an institutional loan, they would go with hard money. Or maybe they have to close really fast. Maybe you got to close in 5 days.
Yeah.
Or they want to skip the appraisal process, the credit process. Or maybe they want high leverage, right? Those are the hard money loans. Now, you're going to be paying a much higher rate, probably more cost, more points. Your margins are going to get, compressed. However, it's become very popular, for sure. So that's the difference between the two in a nutshell. There's obviously a lot more intricacies.
And then, private money can be country club guys that have a bunch of cash and then they're just deploying that. And that's more like the hard money type of situation, for an example. And then the debt service that you were talking about, that type of loan, that's more of the DSCR that I think anybody that's watching may have heard of that.
Yes.
And that's the debt service coverage ratio, correct?
It is.
Okay,
yes.
Perfect. Just want to make sure everybody's clear on that. And so, but again, backtracking, that is for investors only, not necessarily private money or true hard money type of investors. That might, or loans, that could be.
Yeah.
But for consistent, that is not going to be an option for them as a primary residence.
Correct. And generally speaking, for any business purpose lender, that will not be an option because what happens is like a lender like us, we're a direct lender. What we're doing is we're closing these loans for our clients, hopefully in a very quickly, efficient way. But we're also packaging these loans up and selling them to the institutional money on the secondary market. An institutional aggregator is not going to buy that loan if they know that the PG is living in the home.
Yeah, and
so
you gotta
we're
get it
stuck
off.
with that loan.
Yeah, you gotta get it off. Right.
So that's why we're very hardcore about that.
Okay, so why in Atlanta would you need to close in 5 days?
This circles back to our friends, the wholesalers. Okay.
What is a wholesaler?
So in its simplest form, right? And people are used to primary residence deals, right? So where you have a seller and they have it up for sale and a buyer comes by and offers them, right? And so that you have an A and a B party. What a wholesaler does, and there's a lot of different forms of wholesalers. You've got the individual wholesaler. You've got wholesalers that are massive corporations, right, that just buy up a ton of properties at one time. Well, in its simplest form, the wholesaler is the middleman. So he finds a property that maybe is for sale, or maybe it's not for sale. It's off the market. I mean, I'm sure people listening have gotten calls from people that said, hey, are you interested in selling your home? Well, who are those people? Those are wholesalers. What they're trying to do is they're trying to get you to sell the property to them, right? Or get it under contract. But here's the secret on the wholesalers. They're not actually buying these properties, or at least most of them aren't. They don't use their own money. So what they do is they get the A to B contract, right? Seller to the wholesaler, and the wholesaler then gets that property under contract for $300,000, and then they sell it to an investor for $320,000, $340,000, $350,000 from the B to C contract. The wholesaler is the B in the middle. He never really closes the loan other than at the close where he signs the papers, and 5 minutes later he's using the end buyer's funds to close that loan. And so you've got a lot of wholesalers out there who, and let me just qualify it, there's a lot of good wholesalers, right? A lot of honest wholesalers.
Sure.
However, this has become a full-time job for a lot of corporations, a lot of people. And what they do is they find these properties before the investors can.
Right.
And the investor then is buying this property at 10, 20, maybe 30% more than what they would have if they just sold it or bought it from the actual seller. Does that make sense?
It does, yeah, 100%. Recently, I don't know if you've read this yet, but there's some litigation, some laws that just came down, some penalties that just came down to some wholesalers in Washington, state of Washington. And they come to find out there was incredibly deceptive practices that were being used, as you can imagine.
Yes.
It's like you said, there are plenty of amazing wholesalers out there. That is their job. That is their income. They hold it near and dear, like you hold mortgages near and dear, and I hold mortgages near and dear. We're not doing anything to interrupt our career.
Yeah.
However, greed creeps in, and some of these folks have taken advantage of seniors or
Yes.
very distressed situations and gotten a property under contract, signing documents that they didn't know that they were signed. I mean, there's a whole slew of things, and it's really just a horrible story. And you know that it's happened in the past.
Yes.
I mean, I can't sit there and pinpoint any one in particular person by any stretch of imagination, but I know it intuitively that it's happening out there. And now it's coming to surface in the state of Washington that this has been happening, and to some major players too.
Yes.
So
I'll also say one thing, wholesaling, for example, in South Carolina, wholesaling is illegal.
Really?
They do not
I didn't
allow
know that.
wholesaling. So, you got to look at it and say, is this practice above board or not?
Right.
It can be, for sure. And again, respect to those guys that are out there hustling. There's a lot of guys that are.
Yeah.
But when I say that it has substantially changed the market, it has, to
Yeah.
where the individual investor who's out there making an honest living is having an extremely difficult time right
Sure.
now finding properties with good margins because the wholesalers are getting to them first.
And they have to close within a certain period of time, typically.
Yes.
There's the rub, right? Okay, so there are some wholesalers out there. We won't mention any names, but they require you to use their particular lender, do they not?
So, according to them, no. But I would be remiss if I had said that there have been times to where my investor, who I have a relationship with, was using me, and because it was a wholesale deal, the wholesaling entity, which is a very large entity, said, you cannot use them. You have to use our internal lender. That's not advantageous for the investor.
Oh.
Number one, they're overpaying for the property.
Sure.
But number two, you're not getting the best loan terms. Can you close in the time that they want? Yeah, but it's 5 days.
Yeah.
You're never going to, for the investor, that's just not something that's advantageous for them on the margins.
Can you
It's
really
just
do
not.
the due diligence necessary to determine if it's a viable project in 5 days? I mean, maybe in some scenarios, sure, but
It's tough, right?
Yeah.
And then many times these lenders are doing their own BPOs, which how do you know what the actual value is on that? And that's a benefit to the institutional money, is that, the institutional money that we have requires an appraisal. And usually you can dial in on an actual correct value from a third party that is unbiased. Now you of course know there's some stinkers out there, right? It happens.
Sure.
It happens, but for the most part, like, we can dial in on an actual unbiased value, and that's to protect the investor, not just the lender, the investor.
Do you guys require, number one, your own appraiser, number two, an appraisal management company like we do in the QM world? Is that something that you guys do on the appraisal side of things?
Yeah, so we are required to use an AMC. So that brings legitimacy to the hard money world, right? I get it, the perception of hard money, right? We're all sitting underneath a dim lamp with sunglasses on, smoking a cigar.
Breaking
I
legs,
get it, right?
breaking legs,
yeah,
yeah.
send out the mafia, right? That's not how we operate. And in large part, there's a lot of lenders that, like, we require to go through an AMC because we want to have legitimate numbers. We want to make sure that we're doing things high level.
Yeah.
Now, I'm not saying that those hard money lenders that do their own values or BPOs or whatever are underboard. They're not. There's a lot of lenders out there that do it well. However, there's a lot of lenders, hard money lenders out there that don't do it well, and they're more invested in getting a deal done than they are looking at it and saying, does this deal make sense?
Yeah. I mean, so it's more about their individual return and the potential for recapturing that property, their own benefit, not necessarily seeing the investor succeed long term, which then produces clients and referral partner for life.
Correct.
Is that the gist of it?
Yeah. What I always tell investors is, if you're talking to a guy, i.e. me, right, a lender, that isn't asking you, the investor, number one, what's your profitability? And number two, what's your exit strategy? If your lender does not ask those questions, that's a red flag to me. Profitability is number one. I could probably, Darin, make most deals work. I could. But is it the right deal for the investor?
Yeah.
And you got to ask yourself, do you really want to work 6 to 12 months for free?
No.
No.
I can promise you that. No, not many people do.
No.
So we can make a deal make a profit. Okay. But what's the correct amount of profit you're advising your clients?
Yeah. So the first thing is like when I ask them if they've run profitability, most investors, I hate to say this, say no.
So walk me through that. What does that mean? Like they're not.
I'm
having a hard time even.
Yeah, they haven't really dialed in on the numbers, right? They haven't dialed in on, okay, here's my purchase price, here's my renovation. Within that renovation, have I accounted for extra expenses? Most of them don't. Most of them don't have a contingency on there. You have to do that because when you open up the house, you don't know what you're going to find.
Sure.
You just have to expect that, right? A lot of them have not accounted for loan cost, initial loan cost. They've not accounted for carrying costs, right? What's it going to cost during the life of the loan? So if you're in a project that's going to take you 2 to 3 months to finish, let's just say it's going to take you another month or two because days on market is increased.
It's increasing, yeah.
So you got to account for that, right? If you talk to most investors, cosmetic, they're in and out in 30 days. That ain't going to happen, but they don't account for it. As opposed to a larger project where it might take them in excess of 12 months to do. So they don't take that into account. And then at the end of the day, when they put that house up for market, are you using Realtor or are you not?
Yeah.
And a lot of them don't account for that. So their profitability might look like 20, 25, 28%. But once you account for that,
there's another 6 right out of the gate.
Exactly, right?
What about, are you advising them to take into consideration short-term capital gains as well?
Yes, if they can. Sure.
Yeah.
Yeah. I advise them to take into account everything every factor they can, and if the numbers still look good, let's do it.
Yeah.
Now, I'll have investors say, "Well, I know the numbers don't make sense, but I'm just going to lower the budget." And I say, "Time out." Throw the yellow flags. That's a penalty right there. No, all you're going to do is just devalue the rehab, right? The quality of rehab, hence lower the ARV.
Yeah.
What you need to do is you need to go back and renegotiate purchase price. Well, they're not going to renegotiate purchase price. Well, then the actual course of action should be to walk away from the project. Right. If the numbers don't make sense, they don't make sense.
So getting back to the original question, what makes sense?
Everybody's got their own threshold.
Sure.
They do.
So is it? But what like when I don't do a ton of flips.
Yeah.
Okay. But I've been more of a long-term hold, buy and rent out long-term. That's really been the majority. Sold a bunch over the last couple of years, taking some money off the table. When opportunities come around to flip, I will do one.
Yeah.
Did one 2 years ago, just down the street, just went under contract. You and I have discussed this particular property, and I think it's a great opportunity. And I'm trying to net a minimum of 20%, after everything that you've accounted for. What's funny is I always put 20% into my contingency because my wife's involved in it. So I always throw an extra 20% on
Mama
top
needs
of that.
some shoes, right?
For sure. Yeah. But that's what I truly am aiming for. And I'm just wondering, is that sort of, that's what numbers I feel I can live with based on my purchase price, based on what I believe the house will sell for. Now, is that a good number though? Like, what's industry standard, I guess?
So I would say for you, yes, that's a great number. Would I like to see every investor up at that number? Yes.
But
Do
not
they stay
everybody
there?
is.
No.
It sounds like. No.
I'll throw out an odd number that I've always kind of dialed in on, and just because I'm somewhat of an odd guy, you have to kind of be in hard money, right? But my base is like 13%.
Really?
It's like if you dip below there, and what I mean by 13% of ARV, right? If you dip below that, why are you working?
Yeah.
Just think about this for a second. Like if you got a $300,000 ARV, that makes out to about what, like
$39,000.
Yeah, like that. And most of these take a year to do, right? Six to 12 months. So do you really want to dip below that? It doesn't seem worth it to me for all, like, and these investors are working hard.
Yeah, 100%.
You know, I mean, they put, you know, blood, sweat, tears into this whole thing. And all the, like, as far as like managing the project, you got to get paid for your money. So why would you work for free on this?
Yeah, 13 seems low. The previous one that I did, I was at 18%, and I was kind of bent out of shape about it, you know, but you know, the numbers still worked, so I was willing to negotiate down a little bit. You know, I allowed it to happen.
Yeah.
I could have played hardball to try to get that extra 2% to get to my 20% really ideal number, but I didn't. I let it go because I could live with it.
Yeah.
So to your point, everybody has their own sort of threshold. Everybody has their own number that they want to hit.
Yeah.
But goodness, yeah, 13% for me, that would be tough for me to even pencil out. I mean, it wouldn't make a whole lot of sense.
Yeah.
If I got to that number right out of the gate, I'd be like, no, it's not even worth the risk.
Yeah. And let me explain that number just a little bit more.
Yeah.
That's my very bare bones. Like, you know, when, like anything below that, I'm raising not just one eyebrow, but two, right?
Yeah.
I'm like, what are you doing, right? What I'm saying, like, that's the very minimum where I would advise this, you know, project to move forward. There's a lot of other factors. Like if the investor is actually like, if he's holding it for long-term rental or Airbnb, that number kind of makes sense, right?
That's exactly what I was getting ready to say. If that's the case, I would have turned automatically back to a long-term buy and hold.
There's a lot of different factors that go into it, but when you ask, like, you know, for me personally, like, I would love for them to be up at that range, but the reality is, for most investors, kind of going back to the wholesaling point of view, their margins are being taken by these larger entities that are just full force out on the streets, knocking on doors, getting these properties under contract, and these investors are having to go to the wholesaler now to buy instead of direct to the seller.
So does it make more sense to just be a wholesaler?
In a lot of ways, yes. If you can do it.
Because a lot of these wholesalers, they're borrowing the earnest money. So they've got zero skin in the game.
Zero.
Other than their time, their efforts, you know, knocking on doors, making phone calls, whatever.
Yep.
Interesting.
Yep. But you got to be a hustler to do it. And you got to love it, right? And
not many people love to cold call, first of all.
No.
And certainly don't like to knock on doors.
Well, you know, nowadays you knock on a door and you get met with a gun. You know, people are like suspect for anybody who knocks on a door anymore, right? So it's not as easy as it used to. But yeah, you know, that's why I think here, especially here in Atlanta, you know, I joked a little bit earlier, you know, in our conversation prior, is like everybody in Atlanta is a wholesaler now. Well, this is the reason why. This is why it's changed the game for investing here in large markets like Atlanta.
But if you have a wholesaler and a contract in a wholesale position, you got to have a buyer, right? So there's still people out there, to your point, buying, making 10 to 13% margins, which
But that's
tough.
where the game has changed too, where the investor's just like, forget about it. They have a wholesaler now, and the wholesaler's like, hey, every house that I get, I'm sending it to you, and I'm going to give you first dibs on it. So it's like it's a network for sure.
But so I would argue that real estate as a whole, especially in the mortgage industry, it sounds like in the investment side of things, it's a margin crisis across the board. Builders are getting squeezed on incentivizing these properties. You know, I get it. They're trying to maintain that purchase price, you know, keep their comps so they're not upsetting the folks that they just recently sold to. But they're also giving up 40, 30, 50 grand worth of incentives to keep that price where it is.
Yes.
I mean, I was on Resi Club. I don't know if you're familiar with them. It's a service, real estate service. They've got a web, you know, newsletter, so on and so forth. Really analytical, lots of data. And where a couple years ago, builder incentives were basically 0%, right? That was obviously during the rush. But now it's increased to 13% of the total transaction. And I feel like in my mind, I actually feel like it's 18%, but I'm going to stick with 13 just to be to give them a little more credit. But so again, a margin crisis across the board. But you're seeing, you know, still a lot of hunger, a lot of people craving that hard and that hard money transaction.
Yeah, I mean, it's funny you say that because that's I think why I'm seeing a lot of investors turn towards new construction now, because the margin in the flips is just not there. a lot, like we talk about the wholesalers, they can't get their hands on a piece of land where an investor can. And now they're just starting from scratch. The big thing for investors, though, is the conundrum that they're in is, how do I transition from a flipper, right, into a new construction? Because most lenders out there are going to require previous new construction experience. So how do I make that transition?
But Consistent has an answer for that.
So we are, for experienced flippers, right, and they have a track record, we do have options for these guys to transition into the new construction. You're right. And so, yes, new construction is a completely different beast, as you know, right? It is. But done right, with the right builder, the right general contractor, the margins are a little bit more, for sure. The options are more as well. We're seeing a lot of BDR right now.
Explain what BTR is.
Build to rent. So, these investors or home builders are building these homes, and there's no intention to sell at all. It's just simply to rent these things out.
Right.
So we're seeing a lot of that as well. And so those margins, although it may not be a recap right away, it's a long-term play for them.
Sure.
And we're seeing that.
So when they're looking at that, I mean, obviously there's a mortgage. Now, in that scenario, let me take a step back. In that scenario, when it's a BTR, you're doing the long-term financing for that as well? Or is it going short-term and then going to a permanent type of financing?
We're hoping to do the long-term financing for them. I mean, that's the hope, right?
Yeah.
So
to be clear, in the beginning, it's just really the short-term construction loan.
Yeah, and then what we would do is we would transition them into the long-term debt service loan. Now, people ask, well, is it a refinance? Yes, it's a refinance. We have to, it's a brand new product, brand new loan, new title, everything. So we've got to refinance the property.
Right.
So we're going to go off of course, the current as-is value, and then either the market rent or the long-term rent, whichever's lower. And so normally we can pay off the existing lien. Sometimes we can give them a little bit of cash back. Investors love to recap so they can move on to the next project.
Sure.
The BRRRR strategy was huge, especially through COVID. I mean, these investors were just rolling.
Break down
right?
that. You're lots of acronyms, man. Not everybody. Provide everybody tell them what the BRRRR method is.
Yeah, so it's buy, renovate, rent, refinance, repeat.
Right.
Okay, so basically what they're doing is they're adding value to the property through the renovation. The as-is value is much higher at that point. They're refinancing the short-term loan that's on it at that point. They're getting a little bit of cash back, right, to recapitalize what they put into it. And then they're taking that money and going to buy another property. Now, this method worked fantastic during COVID because rates were so low and values were going up. Right. It's a little more difficult right now, Darin, just to be honest with you, to get them cash out just because rates are higher and these loans don't debt service at the 75 to 80%, anymore. Or it's difficult to anyway. Nonetheless, there are still a lot of investors out there that are still burning properties. Maybe they're not getting cash back, but they're locking it up long term, and they're hedging their bets on values to continue to increase in the future.
Sure. And of course, there's still that demand. I mean, let's transition just a bit for a second, because we're in the Atlanta metro market. Still crazy demand, still migration numbers, still staying positive on an annual basis. So people want to be in Metro Atlanta. Yeah. So if you're an investor, there still are opportunities. It may not be the fix and flip. It may not be build to rent. Maybe it is a long-term hold. I mean, but the point is there's options here in the Atlanta market. Why Atlanta?
Well, like you said, there's so many people that are moving here. It is growing tremendously right now, obviously. So, 10 years ago we talk ITP inside the perimeter was the place to be. Now, a lot of those properties have either been picked over or they're just way too expensive. Yeah. So investors are now going OTP, right? And so we see this in our little towns of Woodstock and Canton, right? To where you could get somewhere 10 years ago, and now you can't get anywhere here because it's just exploding. Right. To the builder, to the investor, that's opportunity. And that opportunity is not limited to rate. Where like the primary residence, like it's slowed down a little bit, right? The QM world has slowed down quite a bit because it's rate centric. Our industry, right, the investing side of things, I'm not saying that it's impenetrable, and it's not, but it's largely not dependent on economics, what's going on in the economics and the rates.
Yeah.
Most investors, they don't look at a 10 or 11 or 12% interest rate on a flip or new construction. What they see is the profit in it. And what they see now is they see a lot less people in the markets because rates are low. Those people only focused on the rates.
Yeah. Investors
are focused on profits.
Right. And for the right price, any deal can be made.
Oh, absolutely.
Right.
Absolutely.
I mean, there's opportunities out there. You just have to know where to go to get them. And I think it starts with conversations, right?
Yeah.
I mean, you have to be willing and to put yourself out there, to have conversations with at networking groups, individuals. If you're sitting at the bar, let people know that you're in that market. But what I learned a long time ago is you got to be able to pull the trigger every now and again.
Yes, you do.
If you only talk and never pull the trigger, those deals stop coming by.
Yep.
But if you're known to buy and pull the trigger, they somehow magically show up.
Yeah, absolutely. You're exactly right. And you're always going to have 1,000 excuses not to do it.
Yeah.
Right. But for me anyway, if I have a home that I'm looking at and it's $400,000 and there's 5% of the buyer's pool right now in the market, I'm going to jump at that.
Yeah. As
opposed to, with a higher rate, as opposed to in 6 months if rates go down. Well, now I've got 75% of the buyer's market jacking that, up to 425 or 450. Why would I do that? I can always refinance.
Yeah.
Through mortgage, right?
That's right.
In the future.
Absolutely. Sooner rather than later. All right, Nate, leave us with what's a couple pieces of advice. I mean, you've given us tons of advice and great conversation. Thank you very much. I knew, when we first met and had a conversation, I already knew I was going to have you on there because you're sitting in a unique position where you're essentially going over deals on a daily basis. Yeah. I mean, and you're making them happen. You're working with your borrowers and your buyers, and giving them good advice. And actually, before we do that, before you leave us with some advice, where is a good place to get accurate information?
From someone who knows what they're doing, and knows the market that's been in it.
But how do you find that? Like, I mean, I can sit here and talk all day, but nobody, they don't necessarily have to believe me that I've done this or you've done this. I mean, how do you vet that? Everybody's a talking head right now.
Yeah, exactly. So hopefully, we're just not talking heads, but we come with experience, right? But I would say the investor challenge who you're talking to over the phone, right? This isn't just about rate. This isn't just about leverage. This isn't just about how quick you can close. It's about a relationship with someone that knows exactly what they're talking about, and can advise you in the right way. I know it's kind of weird to think about this, but I look at myself as an advisor. Right? Just like a financial advisor. Like 100%. You don't go to, someone who doesn't know what they're talking about and has never invested in the market. You're not going to give $1 million to them. Well, why would you do the same to a guy that's never owned a home before, invested? He's just looking off a rate sheet. He doesn't know what he's doing. Yeah. Right? For the most part. So, what I would say is find someone that knows what they're talking about and just ask just a few simple questions. I have no problems with people asking me, hey, how long have you been in the business? What companies have you worked for? How many deals have you closed in Atlanta? Do you know where this neighborhood is in Atlanta? Ask me.
Love it.
Like, I'll tell you. But I'll also, be able to tell you if I like the deal or not. And I can tell you no very quickly. Where other people would say, yeah, I can get this done. Yeah, I can get it done too. But no, you shouldn't be going into this. Yeah. That's the biggest thing that I would put people around you for investors. Put people around you, GCs, home builders, mentors, lenders that are honest with you and aren't just in it to make a buck, right? We're in it to make a lot of it, but it's on the right deals, giving
Sure.
right advice. It's a relationship.
It doesn't do us any good to put somebody in a position that's going to have a problem with that particular deal, or they're going to get foreclosed on, or whatever the case may be. It doesn't do the industry any good. It doesn't do our reputation any good to put somebody in a bad position.
I won't name any names, right?
It's out there.
But there isn't a day that goes by, Darin, that I don't have an investor come to me with a deal that is in a deal they should have never been in the first place.
Yeah.
They should have never been. And now they're over leveraged. They're stuck.
Yeah.
They can't get anywhere. They're losing money. But the lender that originated, they made a ton of money off that deal.
Yeah.
What do they care?
Got to do your due diligence.
Yes, absolutely.
For sure. Any last piece of advice?
Yeah. Well, again, I would just say surround yourself with people that will be honest with you in this business.
Yeah.
Because there's a lot of yes men out there.
Sure.
Challenge what people are saying, and surround yourself with people that you can trust. It's about relationship. If you link up with the right relationships, you'll get a fair deal. I promise you.
Yeah.
I promise you that. So that's what this business is about: is getting good advice from good people.
It just opened up a question for me. So a fair deal. I feel like it's the old adage, pick two of the three things, right? Good service, good price, good quality, or whatever that is. I mean, if you are getting rock bottom prices on the lending side of things, typically it comes with less experience.
It could come with less experience. It could from maybe it's just that person that you're talking to is willing to devalue themselves just to get a deal in the door.
That's true.
It could come with less personalized touch and more technology. I do see that a lot. A lot of the massive companies out there, they give really good pricing and really good leverage, but you can never get a hold of anybody.
Yeah.
It's not a personalized thing. This is a personalized business. You know that.
Yeah.
And you got to have people that are walking through things with you. When you close a loan, do you have a company that's going to be there and walk with you through the renovation? What happens if you have issues there?
Yeah.
Are you going to get lost in an 800 number, or do you have their personal cell phone?
Right.
That's where we come in.
Yeah.
We don't have 800 numbers. These investors have our personal emails, our work emails, but our personal cell phones. We're picking up at a moment's notice. We're not perfect, but we resolve to make those those issues go away very quickly and right the ship. So
Now, where can everybody find you?
Yeah, they can find me on Instagram, Facebook, but to be honest with you, email me, right? I work off my cell phone a lot. Hopefully people, appreciate that
Sure.
they can still get a hold of someone there. So, I can be reached on my email, my cell phone, our company website, consistentcapital.com. We are all local here in the Southeast for the most part. We do loans in 37 states.
Okay.
But we are local here. We know our markets, and so if you'd like to give me the specifics of the email and cell phone, I'm happy to do that.
We'll put all your information in the description below, and then we'll have it edited right underneath you. So it's going to be perfect for everybody to find you and locate.
Ruggedly handsome face, right?
Nate, awesome conversation. Thank you as always. Really appreciate it. It's been a pleasure to get to know you over the last couple months and really enjoying this partnership that we're developing and looking forward to doing some deals together, helping other people do deals. And I can certainly put you in contact with Nate if you have any sort of questions or any concerns, whether you want to discuss a deal, need lending opportunities, whatever the case may be. Maybe you're a broker. Maybe you're in a mortgage loan officer that needs a contact for a BTR, a DSCR product, whatever the case may be. Don't hesitate to reach out to me. As always, I don't know if you know this, but this was actually guaranteed conversation. We'll see you on the next one.